Once again, the market stopped short of a big melt-up rally. The clock is ticking on when we might get that because it looked like we were all set up for a big move, a broadening of the rally after inflation came in light on Wednesday, and then today when PPI came in light, but we just can't kick it into gear and we keep falling back on all the tech stuff. It's starting to look like the market's getting more concerned about the economy relative to where the Fed and inflation is, and that we don't have a lot else going besides big tech. So naturally the money just flows up there, and that's why stocks have had the green light and everything else is yellow. Not changing bonds yet, but one more strong day for treasuries and that light should go green because it does look like the market has determined that the trade-off between growth and inflation is turning negative again. That's why I was surprised to read a story in Business Insider citing Big Short's Steve Eisman, one of the guys that was real popular from the movie and still a big investor, who said the economy is more dynamic than ever and he's not worried about a recession because of that. Couldn't disagree more. It's quite the opposite. It's not that the economy is terrible, but dynamic is certainly not the word I would use to describe it. It's really quite the inverse. Dynamic means you've got a lot of different options. You've got a lot of ways you can go. That's not the case right now. This is a single jet engine running on artificial intelligence in the AI trade. And the market's starting to figure that out. Look at the way increasingly bad data are not turning into good stock results. The market's kind of growing out of that. And in some way it's refreshing, but it also probably tells us that we need to be aware of potential slowdown again. I know that there's been several instances over the last year and a half, more obviously, when the market's kind of cried wolf about the economy. But the thing is that right now, the data are pretty clearly worsening as far as jobs go. Despite the big employment number, when you look at the trend still off of the peak employment here in the U.S., you can't deny the trend is worsening. And then what you see in the market, it tells you this lately that people are starting to pay attention. We got this big bid in bonds. That's the blue line from this morning on PPI. Stocks tried to go with that, the white line S&Ps. And then as bonds kind of eased up a little bit, stocks came off. And then when stocks really started getting hit, bonds picked it back up again. So bonds caught a risk-off rally because stocks were down. Now, ultimately, we did get a little push into the closing bell. But this is starting to add up. And we have been seeing more and more of the market generally not rewarding bad data like we got for the jobless claims. That's because we heard from the Fed yesterday that they still need more data to start providing relief. And I do think that's the right move for Powell. They've told us that they need to get a lot of progress towards their target. So even though we had two really good prints this week, it is progress. It's not a lot of progress because earlier this year, the inflation data were going the wrong way. Here's the inflation surprise index, white, versus the economic surprise index, red. Yellow is the zero bound. Inflation data generally has still been surprising positive. This week was a great exception to that, but the economic data still mired down there in negative territory, disappointing, is not a good combination. So if the Fed can't move at the speed the market wants it to, then you start to see some of that economic worry creep back in. The yield curve is another way to look at this, and it's generally held its range, but I do still believe in the signaling power of it, even in the short term. And actually what you got for the 10s to the 2s has been a little bit of flattening. Here's Wednesday's session. The curve flattened. This morning it tried to open back up, but then it flattened again. All of this is generally happening in a range, so it's not super terrible just yet. But the fact that the market can't find this big melt up is because outside of AI, there's not a lot working. You got to have one thing or the other, cuts or economic strength, or we're not getting either. So the money keeps going into AI until it stops.